Welcome back to the Steps to Soul podcast. Today our topic, why you should hire a qualified broker or M&A advisor, even if you think you already have a buyer. Chris, welcome back to the show. Good to see you. How are you doing?
I'm doing well, Brandon. How are you this morning?
We are doing well. We are on a Wednesday edition recording for once, so we're both a little off our schedules, but we're glad to get it done for this week. And honestly, this may be a self-centered topic for us. However, there are a lot of times out there we get the phone call after this was not discussed by a potential client, and it's a lot harder to repair. So today we're going to kind of cover why you should talk to someone like us before, even if you think you have a buyer. There's a lot of aspects and value that can be brought to the table, but also things just to consider if you think you can get the deal done yourself. We're never anti not using a broker. We just want you to know, for those of you listening and buyers, things to expect, what to know, and how to prepare. And honestly, it happens all the time, right, Chris? A business owner gets a call from a strategic buyer, maybe a private equity group, a private investor, just a businessman in town, right? The guy with money.
Yeah, exactly.
It says, I don't need a broker. I already got my buyer. I can handle this. And sometimes, those mistakes from that, if you've never done a deal, especially for those of you listening, this is really for you. Because if you haven't done it, you don't know what to expect. Just like any job or any profession in life. If you haven't done it before, there's always the learning curve, loopholes, strategic plays you want to make to be successful. Just like we talked about in the last two episodes, what to ask before the LOI and then what to expect afterwards. The whole process of setting this up correctly is how you maximize your value, but also protect yourself. So it's about creating leverage and controlling your narrative. Most owners only sell their company once, right, Chris?
Yeah, exactly. It's a once in a lifetime thing for many business owners, for sure.
It is, but professional buyers do it all the time. So there is a level of expertise and a strategy that you need to be aware of. And it doesn't mean it's bad. No one is trying to take advantage of anybody else. But when negotiating a deal, you want the best deal for you. And not all buyers want to give you the best deal for you. They want the best deal for, guess who, Chris? Themselves. That's negotiation. So knowing how to use it properly, having the right team of people in place, we always stress that. Accountants, lawyers, financial advisors, whatever it may be in your region, in your industry, we're one piece of the cog that can bring value, but also help you. So let's start with basically the first thing that happens. One buyer is not a strategy, Chris. It's a negotiation disadvantage in a lot of times, especially when you get outreach out the blue. It doesn't mean the outreach is bad. It doesn't mean the buyer is bad. But one buyer is not market. It's not telling you what the market's going on. It's one person making one approach and one opinion. And competition is always good. It's okay not to have multiple buyers at one time. But a single buyer only gives you one thing, right, Chris? One slice of the pizza, what their thought is. And often, it's not always the same. If they're not in your industry especially, you're not sure what you're going to get, correct?
Yeah, absolutely. Here's what I see behind the scenes when I come into a situation where seller's got this one buyer, as he likes to say. The entire process is subtly shifting around their orbit and their convenience. It's all around their timeline and their questions, asking whenever they want to, whatever their financing needs is, their comfort level. And what happens to the seller? Well, they start adapting to this. They've locked into this as this is my buyer. This is my only buyer. So I see buyers then start extending deadlines because they're not ready to maybe part with their capital just yet, or they got more questions, or committees still asking questions. So they're not holding to deadlines anymore. And the seller is accepting all these delayed responses. They're just going along because what else do they have? They didn't put it out on the market. They don't have three or four buyers at the same time. They didn't have a chance to choose the best buyer out of three or four. They went with the guy who walked in the door. Yeah. And so they start overlooking small changes that you and I as brokers pick up in the language and the things that are happening, the actions that are happening or not happening a lot of time. And that's when drift starts happening. You start drifting off the timeline. You lose your leverage. So one thing to know is competition when you're selling your business, it's not just about raising price. It's also about stabilizing behavior and making sure you're holding a buyer to the timeline, to everything else that goes on in a deal, and making sure that, hey, if you're not going to buy this, if you're not going to hold what you said, we can go to these three or four other guys that we got lined up. Chris has got them lined up all day, every day. And so we've chosen you. You've got a chance here. But if you start screwing around, we're going somewhere else, and we do it all the time when needed. It doesn't happen very often, but it does happen. But that's why we run a professional process. Let me ask you this, Brandon: Have you ever noticed how good buyers they tighten up when they know they're the only option on the table. Like if they kind of do what they want to do when they know, hey, I'm the buyer and nobody else is competing for this business.
There is a lack of leverage there. And especially when we're brought in after the fact, it's very hard to get that buyer's mindset to push and get things done. Often now they view the broker as almost a hindrance. But in reality, if that buyer has been stalling, and we've been brought in sometimes where owners have called and said, hey, look, I've had this buyer talk to me for months, even years. We have some language. And I was like, well, first thing I asked is, do you have anything in writing? If the answer is no, I said, then you don't have a buyer. You have someone that's taking your time and keeping you almost like their side girlfriend, right, to their marriage. I want you right next to me, so if something goes wrong, I can snatch you up, but I'm not willing to fully commit. We turned on a client this year because he wasn't willing to commit to us to bring us in to help, and he wanted full exclusion. I said, the person you've been talking to for a year and a half has never given you anything in writing. They're dangling the golden fruit in front of you, and you can't stop looking at it. They know they have you by their timeline, and they're hoping to wear you down to eventually give in to their demands. Good buyers do behave a little better when a broker comes in, especially if they've done deals before. They understand we're not here to get in the way. We're here to help get some clarity, get some timeline. And to be fair to you, there are sellers that don't follow timelines well either. And a good broker is going to come in and an advisor is going to say, hey, we have deadlines and things to meet. Here are key strategic points and data points and relationships with lenders and financing and accounts we have to organize. We can often speed the process up, or at least bring the process to a close if it needs to end or where it needs to go to. Not to kill a deal, but sometimes a broker has to say, hey, this buyer can't do it or won't be able to do it. And the owner has to realize that. It's not fun, but it is a part of deal making that does happen.
Yeah. And I think what you're talking about is a structured process on both the
Absolutely.
seller side and the buyer side. And I've noticed when there's a structured process in place, both sides they have a different psychology about getting this deal done. They clean up their process a little bit sooner. And I would say this, the difference of a structured process in place, it's not going to show up on day one.
Mm-hmm.
Literally, because the broker's now involved and he's telling everybody kind of being the
Absolutely.
quarterback of the deal. But over 90 to 120 days, it can honestly mean millions of dollars or even a collapsed deal that didn't go through if it's not in place.
No, you're right. And often the first offer is friendly like that. It feels like it's going to work out. It feels good. Everybody's excited. Yeah. There's emotion. And nothing better in business when it's organic outreach. Like, hey, man, I would love to buy your company. I'm interested in it. Can you help me? Right? Or I'm interested in looking at your company. Those are great, especially if you're in the same industry and you have a good relationship. And the price may even feel correct. But both parties need to realize there's still a lot more steps to go than just, hey, we had maybe a cup of coffee or a drink at the bar, had a good conversation, and then it's like, okay, well, it's time for the offer, right? We agree we both want to do something, maybe we're interested in it. That's fine, but just know not all buyers are going to approach it with good intent. Most are, and I say this full-heartedly, most are going to approach it with good intent. But there's no, like you said, a lack of structure. It's still hard to get it across the finish line if both parties have to, one, run their own companies, but two, then find time to make this deal work. And that's not always, if you've never done it before, realize how much work that is, right, Chris? And so let's talk about this. The first offer is rarely the best offer, or not. In our industry, in my experience, in my 14 years, our company's 26 years, very often when working with us, the first offer is very close to the best offer. It doesn't mean it's the only offer. It doesn't mean it's the only good offer. But often it is close to the best. And why is that? Typically, if you've gone to market, you've structured correctly with a good advisor and broker, the buyers are coming through or looking in that space are going to be very motivated, willing to put something out there. As you know, as a business sits too long or owners show lack of capacity to help out, the next second, third, fourth, fifth person down the road kind of goes, well, why did nobody else buy it, right? It's not stigma. It just starts to kind of get that feel. The issue there with people who think they found their own first-time buyer is, oh, this offer's great. Well, did you outline all the real contingencies? I'm going to highlight last week's podcast again, Chris. Knowing the right questions to ask and what to ask back as the owner is just as important. And I think too often, first-time buyers think, oh, I'm just going to do this deal. And then they start going through the minutia of structuring and go, I didn't think about this issue. I didn't think about that issue. Oh my gosh, my offer doesn't make any sense now. Now you've got conflict. Now you've got disappointment. Now you've got a deal that's teetering because both parties may not know how to properly fix the issues at hand, reform the deal, and still keep the original structure to some degree and pricing in place. But there's ways to work around that. What do you see in what we bring to the table at that time? Or have you had a case like that where you had a seller with a buyer that kind of got the offer, but it kind of got to that stalled out phase and we had to come in and correct it?
Yeah, so it's bringing in a broker at any point, whether you've got the buyer or not. It's not all about just finding buyers and getting the price. I think a lot of people think that's all brokers do, and then we sit back and relax and
Hmm.
wait for our check to come in. It's not at all it.
No.
We've got to pressure test the structure of the deal. Is it financeable to even start with? You've got a buyer that comes in and they
Hmm.
make an offer. Maybe it sounds great, but if they plan to use financing and haven't even run the number themselves, they're going to find out very quickly when they take this to a bank that, hey, no bank's going to touch this. It
Hmm.
doesn't even service the debt or account for your living conditions. Also, if there's an earnout, is it realistic? A lot of times, we're going to see that on the back end. One thing I work on
Hmm.
heavily is the working capital peg. Is it accurate? Is it inflated? Does it account for seasonality? Last thing you got to look out for is the tax allocation. You've got
Yes.
a lot of people come in, hey, I'll give you $5 million for everything. You haven't worked out the tax allocation. CPAs are going to get involved and do that. But it's a good idea to have an understanding of that. So I've seen situations where the headline number looked fantastic. Hey, here's 5 million. You love all
Hmm.
those zeros, gets you where you want to be. If you could actually take that $5 million to the bank and retire on it. But once you peel back the structure, you peel back the risk, the tax, the net outcome, you're probably material or worse than you thought you would be, and you maybe need more money up front if your business is worth it.
Hmm.
It's a lot of factors in there, but that's where having a broker at the beginning of the process before a buyer even enters the door
Hmm.
is very helpful. But if you've got the buyer, they've made an offer, you think it sounds like something you want to work on, then it's a good time to bring in a broker and let them kind of make sure that they're checking all the boxes, that you're checking all the boxes, that this deal's really going to work out the way you think it's going to work out.
You're right. And buyers price off conservative assumptions. They look for things that they believe they understand and put their perspective into a deal. But just because you've run a company doesn't mean you understand deal making structure. And that can be two very different situations. And you said it best, we stress test the deal. We understand where the road bumps are going to be on the deal and how that certain language can cause derailment if certain financing is involved, certain earnouts are involved, legalese, writing the structure. It's funny. People don't consider that as part of the deal making process, but that's where our value really comes into play, is making sure those points don't derail, or better yet, can be worked around and added in value. And too often I get phone calls post the first offer, seller comes, I had this guy buying, and we couldn't figure out a way to structure it. It's like, what was wrong? Well, he wanted all cash, he wanted all earn out, or this and that. I'm like, those aren't real offers. You're like you said, Chris, you're looking at the zeros behind the number. You're not looking at what was really in front of you. And it's easy to get blinded by that number. You've got to know what your structure is almost more important than the number in front of you. Like you said, for tax reasons, the allocation, and also how it's going to be dispersed to you. Too often, too many offers don't detail that information enough. Even deal structures, an asset or stock sale. I mean, we can go down the list of issues that companies don't know and don't prepare. And a good broker helps allocate that information before or at that time, can come in, decipher it, and add value, which leads to our next major role is controlling the narrative during due diligence. Again, we're not going to do all of the due diligence. That's not our role in the deal. Let's make that clear. We're not here to audit all of your books. That's not our role. But we do a great job of, like you said, one, making sure the working capital has a peg on it, making sure the legalese on the base side of it, not a legal interpretation, saying, hey, this is a key deal structure you're going to need, especially if you're using SBA financing for lower middle market or high value Main Street deals. This is what you want to have written up for the SBA to approve it. Or, hey, guys, the new rules came out this past June. You need to know that this owner, you're planning for him to stay on for 3 years, doesn't meet their criteria. So we got to word this offer a certain way in order to get this through underwriting. We also look at customer concentration issues and other add backs that we know either should or shouldn't be applied, or key strategy to work around. We've talked about it on the podcast before, Chris. You analyze a customer concentration issue with a large electrical contractor you were dealing with, and the ways you helped work around it got that sold for $13 million. But had the owners approached it from their perspective, I don't think they would have got the deal done at all, because they just couldn't see. They were blinded by looking at just the numbers and the revenue and not looking at the internal structure that was holding that company up, correct?
Yeah, absolutely. Due diligence or diligence in general, that's where
Mm-hmm.
you see the difference between somebody selling their own company and where brokers and professionals come in, and where it happens and when it happens.
Mm-hmm.
If you let that buyer come through the door, they make you an offer and you agree to it without any kind of diligence, handing them any kind of information, buyers are trained to reframe risk after the fact. So they made
No
you this
matter what.
great offer. Yeah, that's their job. That's what they do. If they're a professional buyer, private equity, investment group, whatever. What happens? A single customer suddenly becomes dependency. You're going to see that. They're going to tell you that. And you didn't tell them up front. So what they offered didn't come with that information. And now they're telling you that, even though you already knew that.
The
It's all
retrades of every
psychological.
deal.
It's psychological. I've seen a delayed receivable become a collection risk. Well, this customer's always 90 days past due. This is the way they operate. Well, that's not how we operate. So we're retrading on that as well.
Mm-hmm.
Add backs, you talked about those. They become questionable normalizations. You're adding back
Mm-hmm.
your salary. They're saying, hey, we got to replace you. You didn't include that in a valuation that you gave to us up front. So we're taking our number and we're lowering it. The problem is the seller is answering all these questions directly without the buffer or preparation of the narrative. That is key, the preparation of the narrative. You are going to see your deal shift in a matter of days, a matter of weeks, over months. Brandon, what do you think diligence looks like for most first-time sellers? When do they lose control of the story, in your opinion, if they're trying to sell their own business and they accept that offer up front without really giving a CIM, an executive summary? They just said, hey, yeah, that number looks great, let's do it.
I think it's when they get the first true emotional pushback from the buyer criticizing, in their mind, their company. And a lot of sellers take it very personal, and I get that. Our job is also to help buffer those emotions, but also explain to parties why each side wants what they want. We had a deal literally yesterday that's about to close, hopefully next week or two, in our office. I was working with my broker, Gary Cow. Seller came up with a thought at the very end, almost at the closing table. Buyer had to work it out. One seller, I can't believe they'd want this. I can't believe they need us to hang off this license. Well, state regulations require this license is typically not available right at close. It's a short transition afterwards where the buyer uses your license for a short time while they're in application mode. But we can't have its liability. That's how every single business in your industry is sold. That's the only way it can be sold, or you have to shut it down in between, which no one wants to see happen. So what we were doing there is filtering emotion, explaining traditional deal process, bringing logic, and also helping both parties realize here's a common solution to the problem and how we're going to work through it. Instead of letting a deal get blown up over, I don't want to use the word ego, isn't correct, but just emotion and just frustration to, this is a really good idea. Y'all brought the right compromise to the table. We're going to close next week. That's where we bring value. And I think too many sellers and buyers let the ego and emotion of a deal either hinder their ability to communicate effectively or have them hold back in fear of that. But as you and I know, Chris, if those issues aren't addressed early on, they eventually fizzle out at some point in the offer, in the due diligence phase, and they wreck the deal. We've worked one specifically between you and I that was very high tense for a very long dragged out deal for a lot of different issues that we were drained emotionally at the end just trying to get it across the finish line because we have a lot of strong personalities with fair points that just needed regulation and needed to be helped work through the deal. And could they done it by themselves? Maybe. Do I think they could have done without us? Absolutely not. Looking back with perspective now, I think it would have been a lot harder. We made that happen. And both are very happy with the deal, mind you, now. But at the time, it just felt tough. And we've been there. And too often, sellers and buyers forget that this is, you're still courting your marriage because post-close, you have to have a good relationship. And this is where brokers, I think great brokers really, and advisors separate themselves from just the transaction guys. The guys that just pass emails along and sit back and don't get involved. Good brokers anticipate, find solutions, and have them prepared and ready to address if needed, or get ahead of them and address those concerns. That's where you really can lose a deal, when egos and emotion drive tough decisions.
Emotion is a big one. And I mean, I've got 2 deals I'm working on right now. And if buyer and seller were working together, the deal probably would have died months ago.
That's right.
It's a good broker absorbs that pressure. We slow the cadence down. If some days need to pass while everybody kind of lets whatever
Breathes.
is going on in the deal, just let that dust settle a little bit on that issue, and then we can really think clearly. We package our answers professionally rather than just feeding off of emotion and saying what we want or how mad we are that something's happening in the deal. I think the biggest thing we do is we anticipate the next 5 or 10 questions before they're even asked. We know what's coming. We've seen this happen time and time again. And we prepare the narrative in advance, as I said before. That way, you're not getting retraded on. You're not, hey, we already told you that. We came with our valuation, and this has already been announced. You don't need to do your due diligence and then tell us what you found. We've already made you alert to this. You've prepared your seller for that. Hey, you've got a problem. You got a customer concentration in your business, but we're going to value the business like this because of it. And then you're not having to take a huge discount because a buyer comes in and says you got 60% customer concentration. Clearly, you didn't know that, even though you did.
You
And
didn't
we're offering you,
disclose this right away. You
we're
didn't make
offering
it
you
clear.
50% less. Yeah, yeah. It's that kind of game with buyers that you see a lot of times. If you control the narrative, you control the emotion. That's what brokers are for.
Managing expectations. Deals don't fall apart because of bad business, Chris. They fall apart because the narrative gets away from either the buyer or the seller or the deal itself, and people start focusing on the micro points they've now brought up versus the whole picture of what they're both looking to accomplish. And great brokers and advisors kind of keep that path still there, but make sure the problems or issues are addressed so that both parties are comfortable and still want to go forward. Like, we're not just putting a mask over these issues. We're addressing them, correcting them, but also making sure that before we got this far along, in most cases of discoverable evidence, we already addressed it and had conversations about it. So when it is time to have to maybe retrade or make some considerations or consolations, it's okay. It's not a big deal. We knew this could be an issue. We'll have to do a little more deep dive, but we already covered this discussion. And that's so important because when everybody does a deal, you want to hold the deal to the term. That's keeping both parties honest. But if you don't address it and set expectations, you're leaving the door open for tougher discussions. And that's where positioning changes the valuation, Chris. I think we kind of walked into the next topic. Most owners are thinking, I'm just going to hand over financials. We've already done our part. The working capital is already discovered. We're just going to sit back and pass off the information. We're not worried about retrades. But the problem is, like you said, professional buyers, they're going to want proper EBITDA normalization. They're going to want to recast the owner compensation for how much work they're actually doing correctly. They're going to want to clarify where the revenue is coming from, where it can be optimized, pre-deal tax structure, where it's an F reorg or whatever. And I think often as an owner, you don't think of it like that. You think of it as, well, here's my books. They're great. Well, you'd be surprised how many buyers come in and say, well, we saw just a valuation we were disgusted with recently where they went back and just renormalized everything completely out of context to lessen the asset value of the business, which makes no sense. But these things happen. And a good broker gets ahead of it and says, no, this isn't right. This is a misguided step. Let's get some actual clarification on why you use this language. Give me examples why this is even correct, because we don't have to take it at face value. We have to agree upon it at face value. Is that fair to say?
Yeah, absolutely. We know what the market's doing right now. We see it. We talk to buyers every single day. So you get a valuation from a company or an individual that says this is what the company's worth. We know instinctually whether it's accurate or not accurate, whether it's in the ballpark, let's say, where we're not trying to pinpoint something to the dime and to the penny. But we know that small structural adjustments, even they move the needle significantly. You talk about owner's compensation. Yeah, if owner's compensation is not included in the number because you think you got to replace that owner and pay somebody else more or the same, that's two different ways of looking at a company. And obviously it's two different sets of buyers. But as a broker helping sellers, we are maximizing cash value for the buyer. We're trying to say, hey, if you took this business over, this would be your cash value. Somebody comes in and says differently, that's their argument, but that doesn't mean you have to agree with it. Even if they do business valuations all day, every day, you don't have to agree with it because you've spoken to enough people that you understand what levers are being pulled, what cash flow comes in, what cash flow goes. How much value do you think gets lost simply because of financial presentation? Whether it's an owner not understanding what he's actually giving when he gives that buyer that walks through his door his books. If he doesn't understand what he actually does, if he's not the bookkeeper, the CPA, and maybe he's got a off-site CPA that just handles everything at the end of the year, but he doesn't really know his books, how much value gets lost in those kind of deals?
Probably a good 20 to 30%, I would think, just offhand from examples we've seen.
Yeah.
It really also depends on the sophistication of the buyer, because let me tell you this. If a buyer finds more cash flow, they're rarely going to let you know and want to pay you more, I can promise. It might be great for underwriting for a loan, but it's not going to be as far as we're going to give you more value just because. I mean, come on. I've yet to see that personally. Doesn't mean it hasn't happened and there aren't good buyers out there that aren't being fair.
Nope.
But the beauty of us being involved, at least pre-offer, is we can look at the EBITDA, we can look at the cash flow, we can look at the multiples in the industry and give you as a seller and a buyer too, if you're not sure you want to buy this other competitor out, what's reasonable. So you can go in and say, here are some comps, here are the metrics, here's what makes sense on paper and what we have. This is why this offer makes sense for us. And too often, and you and I know, it's when you get into the recast of the EBITDA, if it's not properly structured, it will cost you a deal. I can give you a great example. I'm working with a client now who's been approached by a competitor in the region. They have not had anything but a small discussion and said, before we sell, we want to talk to they talked to their financial planner, wealth management company, and said, go talk to Brandon. So we've had a conversation. I'm reviewing the numbers now. We're looking at the metrics drawn up. They had gone to their CPA before and said, give us a recast of our EBITDA. And the number looks pretty accurate on paper from the accountant. Pretty simple to calculate, but there's a few things I might adjust, but pretty standard. Here's the problem. He gave them a 7 multiple. Their EBITDA is 280. You don't get a 7 multiple on 280 when both spouses work in the business full time and are 2 of the 6 employees of the company. It made their value more than what they were grossing, Chris.
Yeah. Yep.
And had they thought that was a real number and gone to this buyer, you know what happens to that buyer? Gone.
Yeah. He wouldn't have been able to, even if he wanted to, it wouldn't have been financeable unless he was.
Exactly correct.
Yeah.
So now the question is, I told him up front, if that's the number you're going to, one is wrong. I said flat out wrong on the call. Don't have to see the numbers to know that multiple doesn't make sense. And I'm going to give him my opinion. We're going to do an analysis, do a stress test for debt service, and I'm going to present it back to him shortly and say, hey, here's what I think you can do. You can approach the buyer if you want to go to market. These are your choices to make, but make an informed decision. Because that information you were given, unfortunately, is grossly wrong and could have cost you everything. If you're going to leverage off that, you'll never be able to sell your company. And that's okay. If you want to go your route, go your route. That's just friendly advice that we've seen recently. Now, let's talk about this too. We've talked about how we help coming in late. Let's be honest, Chris. Sellers with advisors and brokers on hand are treated differently by buyers, especially professional buyers. Am I wrong?
Yeah, no doubt. No doubt at all.
I find that real professional buyers, when they realize a broker advisor is involved, there's typically 2 ways they look at it. One, they're going to view what the broker's work product is. If they like it, they're going to buy in 110% and really support you. If you have a bad advisor, they're going to want to push that advisor. Thanks for helping. You go sit in the kiddie chair. Get out the way. Yeah. And if you can't, and that's where you have to pick the right advisor. If you don't have that, it's almost more of a hindrance. Because now you've got someone at the table who can't control the buyer or can't control the situation or can't control the seller and just keep the deal on, and I say control, keep the deal on pace. You're just going to hold yourself back. Good advisors gather proper information, display it, present it, and help organize. And good buyers want to work with good advisors because they know the business should be probably and most likely is priced correctly. The seller is informed of proper deal structure and good structure post-close, making their offer easier to digest versus having to convince somebody of all of these different potential, in the seller's minds, hurdles they're going to have to go through to get a deal done, correct?
Yeah, absolutely. There's also a subtle but powerful psychological difference that when a buyer walks into a deal and they see there's professional representation involved, what changes? The questions change. Instead of, trust me, I've seen this before, still even with me involved, they want to hit you with 100 questions before they've even made an offer. They're diving into deep due diligence before you even understand their capital stack or how they're going to make an offer or how they're going to structure it. So maybe they still send those offers, but now you've got professional representation and your broker tells you which ones we're going to answer now and which ones we're going to save for later. You just saved yourself a week's worth of time trying to go through all their questions because you think this is your buyer.
Thought you had to answer them.
Yeah, exactly. Yeah, you if you're in that position, you're like, well, this is my buyer. I've got to answer these. He walked through my door and made me an offer, and now he's sending me a 4-page Excel spreadsheet of all his questions, and some of them don't even apply to this business because they send them out to 100 different companies. So the cadence, I talked about that. The cadence changes. When you don't have professional representation, the buyers get to push you around at their timeline. They get to tell you when they're going to get back with you or how fast they're moving. And sometimes they move too fast. Sometimes you got to slow things down on these things and make sure it's like we talked about earlier. This is a one-time shot for a lot of sellers. There's no need to rush any part of this process. There's a need to hold timelines and deadlines accountable, but you don't need to rush anything. And so buyers assume when they know there's a process discipline in place, they act differently. They also assume the financials have been gone through. That kind of helps the
Yes.
deal move along a little faster. They've realized a qualified individual has looked at these financials, and maybe we've done a recast. I usually have, and we've shown them the ad back, so they don't have to do them themselves. They can still do their due diligence, Q of E, and whatnot. But the other part is, here's the big part: when you have professional representation, they're going to assume competition may exist, even though we're not talking about it.
Mm-hmm.
They know now they're not the only ones looking at this opportunity. It makes them move a little quicker if they really want the deal. You know, what are some things you see, Brandon, when a buyer enters and they know you're involved? Maybe they didn't even know you're involved. Maybe your client had to say, "Hey, I've got a broker. Go talk to Brandon before you talk to me."
Mm-hmm.
How do you think that changes mindset and the way they act around you and the seller now?
You can tell there's a tightening of the lips a little bit in a good way because they now know there's another party in the room that hears the conversation
That's right.
and understands what's being said.
Yeah.
And I find a lot of the good ones and honest ones, typically their first question is, what do you think and what have you seen in your industry? If you've helped someone in this space, what are you seeing similar? Or what are the red flags you see? Good buyers will ask us that up front, and I'll say, absolutely, here's things I love. Here's things I know are going to be concerns. And if these don't meet your metrics, fair announcement right now. And I think good buyers really appreciate that. Someone understanding the industry they're working in, as far as representing, whether it's HVAC, for example, or restaurants or manufacturing, they know you have an understanding of the industry and the hurdles in that industry, but also that you've already kind of seen those potential red flags or non-existent red flags and outlined them. That makes them feel like, okay, the seller has an idea what's going on now. The ones that don't typically like it, oh, great, I got to talk to somebody else. Can I just CC you on the emails? You can tell there's a level of frustration because they know they're not going to be able to dictate all the terms. And it's no longer their deal. It's, I got to go through this guy. I get it. Some people don't want to work for a broker. I don't take offense.
No.
The point we want to make, though, is brokers do bring accountability to the process. And if you've ever done any kind of deal making or any kind of negotiation, you understand when there's a third party handling negotiation, there is a bit of a formality to it that keeps all parties typically in alignment on what the main goal is and what's going to happen. I know buyers say a lot, well, I really want this buyer. I only want this one. I know he's the best fit. What I would say to counteract that, Chris, is yes, this may be a good buyer for you, but it may not be the only buyer for you. And they may come with different deal structure based on their background and capacity to someone else. The beauty of a good broker being involved, even if someone does come to you while we're working with you, is we have a targeted process. We are out there working to structure deals with other buyers to bring other people to the table. You're getting a bigger exposure to the market. So if this offer that you have gotten or may be receiving is of market or at least is within range that it should be. Too often I see buyers say they have an offer and they come to us and say, well, actually, it's kind of a really poorly structured deal what's going on right now. They could easily you don't need to seller finance 85% of this deal. They can go to SBA and get this done if your books are correct. I didn't realize that. Subtle things like that we bring value to. There's other times where I've told buyers, look, if they're sellers, if a buyer's offering you that offer and it's legit in writing, take that offer because I don't know if the market will give you better. You've really got a good one. I'm happy to help you. You want me, but if you've got it done, take the offer. We've had that happen several times over the years, and that's okay. But as an owner, you should know what your visibility is, what it's brought in, and what the market views of your business. And a lot of times it helps you as a seller set proper expectations for yourself. If you do have a buyer come around eventually, or you do want to eventually sell, you understand that, hey, maybe what that accountant told you, that pipe dream your value wasn't correct, or that valuation you got done incorrectly isn't real. Here's a great example, Chris. We have an auto repair shop in Metro New Orleans. The owner's semi-absentee had a valuation done by a company in California that told him he was worth $520,000 to $550,000 on 120 cash flow. No real estate involved. Way too high. Even if it's semi-absentee, way too high. Guess what? We said if you price it around 300, you're going to have a lot of activity. We can probably get an offer. Within 10 days, we got a full price offer from a strategic buyer in the area. Beautiful. Why? Because we priced it correctly, set expectations, didn't undervalue it, and it's still maybe even a little high per se. We still got to go through diligence. We still got to verify a whole bunch more information. But what happened? We set proper expectations. We set it according to proper multiples. We didn't give someone a pipe dream because they gave us a few dollars for a valuation, which we took no upfront money, unlike the other company. And now he's got a full price offer. Working through the process now from a very good strategic buyer in the industry that can execute. and that has done deals before and said, this makes sense. It's amazing the value that can be brought to the table when you do that correctly. What do you see? What do you see as far as the process we bring that brings elevated value to a deal, but also to some degree, I think also helps source better buyers in a lot of cases?
Yeah, we create leverage and we also create protection. If your deal falls apart, you've been working on for 2 or 3 months by yourself, if you had a broker involved, they're still marketing in behind the scenes. They didn't get committed to one deal. I had it here recently on a business. Deal fell apart because the buyer couldn't get his financing together, couldn't get his, let's just say, his shit together. So we dropped him as a buyer. The very next day, I've got another offer in place from a more reputable buyer. Let me go back and say I didn't choose the first buyer. It was forced upon me. It was kind of that situation that we've been talking about.
I want this buyer.
Yeah,
as the old
seller
saying
had
goes.
a buyer who had come back,
A while
6 months
back.
before I even got involved.
Was never very
Had
serious.
resurfaced. And yeah, I gave her my advice that I didn't think they were the right fit, but who knows?
We're going to do our best to help you.
But I think one of the biggest misconceptions business owners have about hiring a broker is that all we do is bring a buyer to the table. It's literally, I can't even wrap my head. That's a percentage of what that entails for me is probably I'm 10% of the way home once I find a buyer. It's next to nothing.
I said the same thing, 10 to 15.
It's very easy for me to find a buyer. I will say it's much harder to find a financially qualified buyer that I want to work with, that I think is a great fit for the business. That probably gets us a little closer. But finding a buyer that's willing to make an offer is for a broker is next to nothing. We don't even market to buyers. Buyers are easy. There's a million out there. Finding the qualified ones is a little bit harder. But in every single situation, whether you've got your own buyer or you're bringing in a broker, you need to understand brokers are going to benchmark structure. We're going to, like Brandon said, we're going to validate pricing logic. We're going to tighten up the terms. And the biggest one is we're going to stress test assumptions. You run a scenario by us that says, hey, what if we ask this? Well, you'd have to find a buyer with 40% down to make that even possible to work. That alone can prevent a lot of time wasted, a lot of regret later. The worst thing I hate to see is a business owner get involved in a deal and 3, 4, 6, 9 months of their lives go by working with this buyer, and the deal just drags on and on for various reasons that the deals can drag on. A lot of times it's just delay and people not doing what they need to do. But that's what I see on my end as far as what business owners think about as far as bringing in a broker to the deal. They think it's just us finding buyers, and it's very little to do with the overall structure of the deal.
In reality, it's risk mitigation.
Yeah.
What we're doing is limiting the risk. And I'll say this. There's no such thing as risk elimination. Okay, I was in a fraternity. I was risk manager. We were taught on, you don't eliminate risk, you manage it because risk is going to occur. You can never fully wipe anything out. And that's one thing that we do a great job of is explaining to buyers and to sellers. You can't have these infinite clawbacks of perfect protections. Every deal there is risk inherently in buying any company doing any deal. So part of our goal is to help psychologically make both parties understand that there's a give and take here. And here's how we mitigate the risk. We can't eliminate all risk, but we can mitigate and properly structure it so that it makes sense for both parties to take a leap of faith and do a deal. Whether that's how to properly structure a seller note, whether that's an employment agreement, whether that's earnout structure, working capital pegs, personal guarantees, to some degree, some tax benefit of that. And then on top of that all, just the non-compete. It's amazing how many times I've had buyers demand certain non-compete structure and early in the deal, and I tell them that's not going to fit Louisiana law. It's 2 years, not 5. I don't care what some guy on LinkedIn told you to put in your contract. It's not going to fly here. So if you can't do a deal because you don't have a longer non-compete, go ask an attorney in Louisiana. They're going to tell you the same thing. It won't be enforceable in court. You can sure have it in there, but it won't mean a damn thing if it gets challenged. It's small things like that, small little details that mitigating risk and properly structuring a deal make sense. It's amazing how many times I've seen a potential buyer that the seller found made them an offer for less than their asset value and wanted the seller finance the rest, Chris. You know what's going to happen there if something goes wrong?
Yeah.
The buyer made a profit selling off the remaining difference of the asset value to what he put down. He'll never make a payment, and he'll walk. And you have lost everything. You have no clawback and no leverage.
Yeah.
Well, I had my closing docs. I was going to have I said, you already sold it. Go track him down. File a suit. Get judgment against him. Good luck. I've seen that happen. The biggest thing we do too that a lot of sellers don't understand is the paperwork we provide allows for leverage and enforceability. It's amazing when a buyer has to sign a non-disclosure. If they're not in good faith, we'll push back on me and Chris immediately. Well, I've already talked to him, so I don't know why I need to sign one. It doesn't matter. You already know what you know is public knowledge, but from this point on, anything else needs to be kept confidential. So I stress to you out there listening, if you're going to do it yourself, you need a good non-disclosure. Don't take the buyers at first glance as good enough. Look at it and review it and make sure it makes sense for you. I saw a mutually beneficial NDA that I signed with helping a client the other day. It's a great NDA, very fair, good language. I'm not an attorney, but I've seen a bunch of them. It looked pretty solid. I've seen some others where the buyer can do whatever they want, basically, and you can't come after them. And God forbid they poach your employees. God forbid they poach your clients. God forbid they poach your suppliers, because there may have been public knowledge. The language is so vague and so unfair to you that all they need is an insight to what you're doing, and they've got what they want. And that's where brokers mitigate that risk. It may not seem like a lot, but when your deal's on the line, mitigating that risk and getting comfortable with the deal and knowing how to properly structure it could be the difference between your deal even getting done. Right, Chris? I mean, you've had many talks with sellers and buyers about personal guarantees for seller notes. You had a buyer that you didn't even help. That wasn't your client that called you because their lawyer offered some ridiculous PG or personal guarantee on a seller note, correct? And you talked him off the ledge. Like, that is horrible legal advice. Nope, not lawyers, disclaimer, but share that story. That's a really good story that applies at this point right here.
Yeah, so the lawyer in this case, the buyer found a gold gem. He found a HVAC company out of near Houston. He just had called around for a bunch of, a lot of HVAC. He was looking for a company. He was going through me to help him find one as well, but I'm up here in Shreveport, so a little bit far from him. But he found his own. Guy wanted to retire so bad. Guy wanted to retire so badly. And so he was just ready. And this guy he would have gone out and done an SBA loan, but they met and the owner trusted him. He's like, man, just get a little bit down and I'll finance the rest. So he was going to put down like $85,000 on a probably $400,000 business. And this buyer's attorney was telling him that, hey, if something happens to this owner, you shouldn't have to pay the rest of that note. And that's just ridiculous. That guy he's not only giving you the benefit of the doubt of paying this note, he's planning on, you paying it and leaving that money for his heirs, for his kids. And that's kind of his inheritance to give to them. And now you've got some lawyer who's telling you really bad advice of you shouldn't have to pay that if he passes away or something happens where he can't help you anymore, whatever the case may have been. When you get advice like that, the guy called me, the buyer, and he's like, hey, what do you think about this? You've seen enough deals. I was like, that's just terrible. You're about to lose this deal, because the seller wasn't going to go for it. I said, you're about
Why
to
should
lose
he?
this deal. I said, you need to check yourself. Like, really, what would you do in his shoes? And he said, well, I wouldn't do it. Well, then why are you expecting him to do it? It's like sometimes you get advice from people and professionals that you trust, and a lot of times they've got good advice, but once in a while they throw out some crap like that. You got to make your own way in this world, and you can't take everything everybody tells you all the time. You got to be your own man and know what you want to do in this world. Sometimes you do due diligence on a deal and it doesn't check out, but if you want to get the deal done, sometimes you can't do, Brandon just used this earlier before we started, analysis paralysis. You can't do that to the nth degree to check yourself out of the deal. Sometimes you just got to trust faith. You got to trust yourself. These deals don't come along every day. And so when you got a good one in front of you and you know it, you got to move forward. And that's my soapbox for the day.
You do. And to be fair, for those of you listening, that is the unicorn of a seller out there. That is one in a million. So that buyer, Chris, made the right decision to do that, because he was never going to find that deal again, in my opinion. And from somebody where the box is all checked out through due diligence too. That is, if someone's wanting to give you that up front from just out the blue, be a little cautious. There might be something going on that they don't have the leverage and you don't know it yet. And that makes a great point. You said, look, reach out for advice. That's where having the right team and referral partners and advisors to speak to directly, with their CPAs, attorneys, wealth advisors, lenders, maybe a fractional CFO or somebody you're going to rely on or your BNI group. But when a client's, say, I think I already have a buyer, I would encourage you to ask these questions. And we can go through them if you want, Chris, but I just want to at least list them out real quick. Has evaluation been market tested? That's great. Do you know your value is real or not? Do you know the right deal structure is optimized for you and for the buyer to make it work? Have you even asked What due diligence risk may be assessed? Your favorite line, has working capital been defined? And the final question is, have you done any tax planning to be integrated for this deal, whether it's a stock sale, an asset sale, the time of year the sale is going down, if you're retaining certain equity rollovers, what that could mean for you. If you're rolling over seller financing into the equity injection for an SBA loan, do you realize there's a 10-year standby? There are so many questions to make sure. Did we cover those basic points? And we've kind of highlighted them throughout the podcast episode. But if you don't have these people on your team or people you can speak to, ask for the right referrals who to speak to. I think I just kind of self-promoted a little earlier. Private Wealth Management Group called me to come in. I'm actually meeting with another client of theirs on Friday, a private medical practice. And as the guy from the Private Wealth Management Company put it to them, Brandon's going to tell you three things: what he thinks the market's going to do, what deal structure you can to get the best for you, and also what you can do to improve if you want to go down this road. And he's going to tell you straight up. And that's what we're here to do. And this is what the podcast is all about, giving you fair, straight up advice so you can make proper decisions. We want to avoid analysis paralysis. You use my favorite term, Chris, besides transferability. I want you to know how to think and make proper structure. There is so much information overload out there that, as you said, Chris, if you start diving into every possible scenario, you cannot get a deal done. That is going to create more risk than you're going to mitigate. And that's what we talk about in risk mitigation, why we come in. I've had buyers ask questions, what if the cook quits if I buy the restaurant? You hire another cook, or if the cook is that dang important and not just an average fry cook, you get an employment agreement before. Like, these are silly questions, but you'd be surprised how many, like Chris said, good buyers will say these things. Not the right buyer. Part of the process. Anything you want to add to those questions, Chris, that you think either I missed or you want to highlight that, hey, if you're going to ask for help, why those questions are important to you or why you should really think closely with those questions before you advance any further in discussions on your own?
I think it's just important to ask ask whether the valuation has been market tested. You need to understand that from, if you got these referral partners, ask whether structure has been optimized, whether tax planning has been integrated. All these things help you understand where this advice is coming from, what the role is. Our role as a broker is not to disrupt relationships in any being. It's to strengthen outcomes and sometimes validation. Sometimes that's what we need to bring to the deal is the validation of, hey, sometimes we confirm the buyer's right. Their offer is good. You're asking this and they're coming in with this. Is this accurate? Yeah, that's a pretty damn good offer. You probably should strongly consider it. So sometimes it uncovers risk, but either way, tell you when you got more advice, yeah, sometimes you get bad advice like the story I just told, but when you have plenty of advice and advisors, you're going to benefit. When you're trying to do it on your own, you're just listening to your own self and you're just hoping.
Scary journey.
Oh, man, I can only imagine, especially if you don't have all the information, if you've never been through it before, if you're not the bookkeeper of the business and you don't even really understand your own numbers, you just know how to sell and make money. And yeah, that's a scary venture. It's good to have these referral partners, good to have advisors on your team. And you need to start, if you're thinking about selling your business in the next 2, 3, even 5 to 10 years, you need to start building out your advisors team if you don't have one. And that needs to be a CPA who can really help you through the process, a lawyer who can do deal transactions, not just your family attorney who does wills and trusts
Title
and
work.
things like that. Yeah, exactly. And brokers, M&A advisors, whatever the case may be.
You're right. And one shameless plug, I'll give a case study before I give you my final takeaways, is I met about 8 months ago with a private equity group that specializes in porta potty and waste management. And it was funny because a lot of times I hear certain bigger groups like, I can't stand brokers. They make us pay more. Or that's not fair. Well, why are they saying that, Chris? Because they know we hold the deal accountable for what it's worth. But he said what made me very happy to hear, selfishly, was I love working with good brokers because often they save me months of due diligence and timelines, and I can convert my capital quicker to get a better ROI and then return to our investors. How is that? Often we get financials in line, EBITDA is lined up, key structures there, and we help facilitate the transaction. And he's like, I love working with good brokers. They save me months and months of time in prospecting. He says, if I have to go out there and cold call every owner, 1 in 20 are going to be even remotely set up to sell at that time, whether it's deal structure, whether it's company structure, financials, all the key parts I need aligned. When a broker typically takes it to market, it's at least 85% ahead of the curve. And that allows me to actually get deals done. He said, nothing wrong not using one. But he said that was his quote to me, as we said at Jay Alexander's grabbing a quick lunch. That's what we're going to stress to you as my final takeaway. One buyer is not leverage. Price is not the only variable. Structure can matter more than the headline value, as you said, Chris. The zeros behind the number don't matter as much as the structure and how it's going to get executed. And finally, narrative controls and determines the outcome. How that is leveraged and mitigated is important, and good advisors and brokers bring that to the table. And what they're going to do most of all, they're going to tell you straight what they think. That's what we do and sometimes have to do, unfortunately, knowing it's going to cost us a sale. But it's the right thing to do to give you honest advice, and you have to make a formal decision for yourself. And I've told my wife I've lost deals because I had to tell somebody the truth, and it hurt, knowing I could maybe spin it a little bit, Chris, but they're not going to do that because it's going to come back eventually. It's not worth it. And I'd rather everybody know right now where their chips on the table lie, and you make the best move for you. And we're going to help whatever way that is. That's our goal. And that's why we get brought into the process. Felt good to say that. Sorry. That felt good. That was relieving.
I got that off your chest.
Yep. So in closing, I will say, even if you already have a buyer, you deserve a professional process that protects what you've built and unlocks the full value of it. And as a buyer, don't be afraid if we do come in. Very often, we're going to help find loopholes that you didn't know were there and get them accomplished so you can achieve your entrepreneurial dream. We're not a roadblock. We're a stepping stool to help you get up to the next step and get you over the hump. In that case, I think we've covered it all today, Chris.
We have.
Lovely episode. Enjoyed it. For those of you listening, you can find us on Spotify, YouTube, LinkedIn, and anywhere else good podcasts are hosted. I'm Brandon Bourgeois. That is Christopher Sater. We will see you next week for another episode on the Steps to Soul podcast. Enjoy.